efficiency, right? These markets are very, very important, right? These markets directly affects the activities of consumers. These markets directly affect the activities of business houses. These markets directly affect the activities of personal wealth. So these markets have a very important role to play in Indian financial sector. Now, coming to classification of financial markets, we have learned that financial markets are the markets which can supply either long-term funds or short-term funds. Right now, when depending upon the type of funds that they are transferring, or depending upon the kind of funds that they are supplying, they can be determined into capital market and money market. Capital market is a market where the securities that which are long term in nature, that is securities which have more than 1 year period of time period, such kind of securities are called as capital long term securities. So long term securities are traded in capital markets, like shares, stocks, bonds, debentures. These are the securities which are long term in nature, that is usually the maturity period is more than 1 year. You call such kind of securities as capital long term securities. And whenever a market deals with long term securities, you call it as a capital market. Not only that, the capital market, whenever you're talking about the capital markets assist in economic development, or the capital market helps in economic development by collecting money which is in excess from those who have it, and channelizing them or providing them to the people who need it, so that they can be productively used. Now, whenever we are talking about capital markets, companies look at these markets so that funds can be collected, right? For providing infrastructure facilities, or in order to carry out the business activities, companies look at these markets for collection of money. Now, whenever we are talking about capital market usually provides facilities or institutional arrangements which supports or which helps in borrowing long-term funds or lending long-term funds. Now, whenever we are talking about capital markets are further classified into three types. You have something called as corporate industrial securities market, that is market which is catering only to the needs of corporate, or market which is catering to the needs of industries. You call such kind of markets as capital markets. Government securities market, here the securities related to government or government related securities are only traded. Apart from that, you have something called as a long-term loans market, market which supplies long-term loans, right? Those kind of markets are called as long-term notes market. So capital market is basically a market which provides or facilitates long-term funds whenever required. Now, whenever we are talking about the corporate market, capital markets, the features of capital markets include, see, capital market is one of the most organized sector of Indian financial system. That is, Indian financial system completely comprises of organized sector and unorganized sector, right? So capital market comes under organized sector. Why? Because it links, it acts as a connecting link between savers of the money and the borrowers of the money. That is, it provides a route, it provides a bridge, or it provides a link between savers and people who want to borrow money for their entrepreneurial needs, or people who want to borrow money for their what do you call as organizational related requirements. Capital market is that linkage between borrowers and the savers. Not only that, capital market is a market for medium and long term finances. If you're talking about short term, only money market can fulfill the requirement. But when you're talking about capital market will help you only for long term and medium term firms. Short term firms, you cannot categorize, or you cannot get short term funds in the capital market. Now, whenever you're talking about capital market, a capital market trades in both marketable and non-marketable securities. That is, whenever we are talking about marketable securities are the securities which can be traded or which can be transferred easily, like bonds, debentures, equity shares. All these are marketable securities. Apart from that, there are some non-marketable securities also. These non-marketable securities are the securities which cannot be traded or which cannot be transferred to another person, like loans, advances, term deposits. all this. So whenever you are talking about capital markets, we are talking about marketable securities of long-term nature. We are talking about non-marketable securities of long-term nature, which can be transferred or cannot be transferred. If you can transfer it, you call it as marketable securities. If you cannot transfer it, we call it as non-marketable securities. Now, whenever we are talking about capital markets are the markets which includes or which comprises of both primary and secondary markets. See, uh, anything related to long term, whether it is marketable, non-marketable, whether it is primary, secondary, anything, something which is related to long term or medium term in nature, everything falls under capital markets. So whenever we are talking about capital markets, it includes both primary and secondary markets. Primary markets are also called as new issue markets. That is, securities are issued first or new securities are issued. We call such kind of markets as primary markets. Whereas secondary market is a place where trading of already existing securities takes place. See, for example, stock exchanges. See, whenever we are talking about primary markets, IPOs, issue of IPOs come under primary market. But whenever you're talking about secondary markets, when already issued shares or when already issued securities are traded through stock exchanges, we call such kind of markets as secondary markets. Now, capital markets has two types of investors. They have something called as individual investors, right? Individual investors can be anybody, that is general public, right? Which might who might be national individuals, or even foreign individuals can also invest in the capital market. So one of the category of investors in capital markets is individuals like you, me, anybody who can individually invest in the market. We are called as individual investors. But apart from that, we have something called as institutional investors. Institutions comprises of organizations. They are not individuals. So this institutional investors can be like mutual funds, pension funds, LIC holders, right? LIC company. All these are called as institutional investors, right? Again, the same rule is applicable. Institutional investors can also be from home country, or institutional investors can also be from foreign institutions also. But there is no restriction as to whether individuals can invest or not, whether institutions can invest or not. There are no such restrictions. You can have individual investors and you can also have institutional investors. Not only that, capital markets always operate with the help of intermediaries like merchant bankers, collection bankers, brokers, underwriters, who are very, very important elements of the market. See, the capital markets do not operate on themselves. They require the help of individuals. They take the help of intermediaries in order to carry out their activities. It can be anybody, which includes merchant bankers, collection bankers, underwriters, brokers, anybody. Now, next, coming to functions of capital market. See, whenever we are talking about capital markets play an extremely vital role in promoting or in continuing the prosperity of any country's economy. See, whenever we are talking about capital market is very, very important if you want your country's economy to grow. So the growth of capital market also helps in raising the per capita income, or the growth of capital market will help you in reducing the unemployment in the country. So what are the roles played by, or what are the functions of capital market is, the first function of capital market is it assists in collecting long-term funds. See, capital markets are the markets that helps business organizations, financial institutions, or government to receive long-term funds or to gain long-term loans from domestic or international markets. So they are the providers, they are the collectors of long-term money or long-term funds. Next is transmitting people's savings to productive avenues. See, capital markets are the markets which mobilizes people's funds. So, because individuals do not know where to invest. So capital markets collect those money from individuals and invest them in productive avenues so that they can be grown or the economy can increase, which is very, very important. Now, whenever we are talking about capital market unlocks unused money which is there in the market. See, keeping money idle will not fetch you anything in return unless and until it is invested. So capital market provides that, or capital market facilitates unlocking that unused money so that it can be invested in productive investments. Not only that, capital market helps in capital formation. See, collecting capital accumulation or capital formation, right, is the major function that a capital markets done or do. They are the providers of money, they are the formers of the money. Not only that, capital markets promotes the habit of investment. Capital markets promotes the habit of saving, right? It facilitates people to save more through either banking or non-banking institutions, and create an awareness about investments, or uses that investment in order to get more productive avenues, is one of the important feature. Not only that, capital markets provide income to investors. See, they are not only unlocking the unused money, but when they are using this money, they are generating income to the investors in the form of interest, in the form of dividend, in the form of capital appreciation. They are providing all the investment avenues, or they are generating income to the investors who are doing it, who are investing in bonds, debentures, shares. They are providing them income in the form of interest, dividend, and capital. Not only that, capital markets also help in liquidity, right? That is, in capital market provides an option to the investors to quickly turn their securities or to quickly turn their assets into cash by trading them on stock exchanges. So it is not that if you are investing in long-term funds, you cannot get your money easily or quickly. No, capital markets provide you that option. Capital markets provide you that facility of investing in such kind of financial securities which can be liquidated easily, which can be converted into cash easily when they are traded on the stock exchanges. Not only that, capital market not only includes domestic investors, but they also include something called as foreign investors. Money can be invested not only by domestic investors, both foreign institutional and foreign individual investors are also encouraged to invest in Indian capital market. There is no restriction that if you want to invest in capital market, you have to be a national of Indian. No, even a foreign individual, even a foreign institutional investor can also invest in Indian capital market. Not only that, capital market is something which promotes economic growth, right? The various activities conducted by capital markets will stimulate economic development, right? They help in growth of economy, which is one of the important function of capital market. Not only that, capital market is something which generates employment, right? These capital markets are the markets which lead to job creation, right? They provide direct jobs in the capital markets, like you can become stock brokers, you can work in stock markets, you can work in financial institutions, right? By providing indirect jobs across all the sectors of the economy, right? Not only that, capital markets promotes stability in securities value. See, whenever you are investing, whenever you are representing your capital funds through financial intermediaries, this capital markets serve as a source of technical upgradation, right? In whatever sector they're working. For example, if they're working in industrial sector, they become a significant source of technical upgradation. They use the publicly invested funds so that they can carry out the activities, which is one of the important function of capital market. So they not only make sure that you invest your money, they make sure the securities that you in which you are investing are stable. They make sure the securities that you are investing, the value of those securities remain constant or same. Now, whenever we are talking about capital market, I told you capital market is a market which can be a primary market or which can be a secondary market. Now, here comes the question, what is primary market? A primary market is a market in which securities like debentures, shares are sold for the first time to collect long-term funds. This is a marketplace where new securities are traded. Whenever the new securities appear in the market for the very first time, these securities appear in the capital market only. So, because it deals with fresh or new financial securities, this market is also called as new issues market, right? Because this is the first place, or this is the first market in which the securities are traded. This is the first place or the first market in which new securities are issued. That's the reason it is called as new issues market. See, whenever you're talking about the new issues market is a place which brings together the supply of money and the demand for money, or the sources of money and the users of capital money, right? The major players of primary market are merchant bankers, mutual funds, financial institutions, and individual investors. These are the major players in primary market. So whenever you are talking about primary market is a market, right, which deals with only new issues, or which deals with securities which are sold for the very first time, right? Whereas when coming to secondary market is a place which deals with securities that are already issued in IPOs or FPOs. IPO stands for initial public offering. FPO stands for follow-on public offering. So whenever we are talking about secondary market is a place where the securities are traded for the second time, because first time they are already traded in the primary market. So security markets, secondary markets, these are traded, right? If you want to take the securities once they are issued for the first time, you go to the primary market. If you want to deal with already existing securities, you will go to the secondary market. This secondary market is also called as stock markets, share markets, or after markets also, right? Now, the major players in secondary market are merchant bankers, mutual funds, financial institutions, individual investors, and you also have somebody called as stock brokers, who are the major players of secondary market. Now, whenever we are talking about the secondary market, right? And as whether it is primary market or secondary market, both of them are collecting long-term funds, or both of them are collecting long-term securities. They deal with long-term securities. That is, they have a defined maturity period, whether it is traded in the primary market or whether it is traded in the secondary market. They have a defined maturity period, and they facilitate liquidity and marketability, which is very, very important. Now, here comes the question, what is the difference between primary market and secondary market? See, as we have learned in the definition itself, primary market is a marketplace which deals with fresh or new securities, whereas secondary market is a marketplace which deals with already issued securities or already existing securities, right? When securities are issued for the first time, you go to the primary market. When already issued securities are traded upon, you go to the secondary market. Now, whenever you're talking about primary market directly encourages capital accumulation, whereas secondary market indirectly encourages the capital accumulation. See, capital formation, collection of capital is directly done under primary market, whereas if you want to indirectly collect it or indirectly accumulate it, you will go to the secondary market. When comes to primary market, in primary market, only buying of securities can be done. You cannot sell them in the primary market. Primary market, only companies sell their securities, and as an individual investor or an institutional investor, you can only buy them, but you cannot sell the goods or you cannot sell the securities under primary market. Whereas in secondary market, it deals with both buying and selling of securities, right? In the secondary market. Whereas when it comes to primary market, the existence of the market or the geographical position of the market is not fixed, because it varies from company to company. Whereas when it comes to secondary market has a fixed geographical position, like you have stock exchanges, Bombay Stock Exchange, National Stock Exchange, right? They have a fixed place where trading happens. Whereas for primary market, there is no fixed place through which trading happens. Now, whenever we are talking about primary markets, securities are not advertised. Securities are advertised but not listed in primary market, whereas in secondary market, only listed securities are available for purchase and sale. See, companies go for advertisement when it comes to issue of IPOs or FPOs. They issue the advertisement, but they don't list it. Whereas secondary market deals with only listed securities, right? When you're talking about primary markets, primary market helps the borrowers to get the money that they want. Secondary market allows the investors to invest in securities and also provides liquidity. These are the prime differences between primary market and secondary market. Now, I told you, secondary market has a fixed geographical position, or secondary market has a fixed marketplace, which we call as stock exchanges. Now, whenever we are talking about stock exchanges are the markets, or stock exchanges are the examples of secondary markets. They are organized one, they are regulated, right? They are organized, they are regulated by various securities, which are issued by corporate sectors or other institutions, right? This stock exchanges are the yardstick to measure whether a country is developing economically, or whether the country's economy is healthy or not, right? Now, over a period of time, previously we had a traditional stock markets where physical trading used to done, but today India has transited itself into an electronic market where the stocks are now traded in only something called as a dematerialized form. That is, you can only go for an online trading, you cannot go for a physical trading, right, in stock exchanges. Now, the Securities Contract Regulation Act of 1956 defines stock exchanges as a body or an association or an organization of individuals which is established for the purpose of assisting, regulating, and controlling the business in buying, selling, and dealing of securities. See, what happens in stock exchanges? People buy and sell the securities. Why? They want to obtain liquidity, or they want to hold these securities in order to get return. For that purpose, they are buying, selling, and dealing with securities in the stock market. So, these stock exchanges are the regulatory bodies, or these stock exchanges are the association of people, right, or association of individuals who help you, who will assist you, and who will regulate you, right, your businesses whenever you're buying, selling, or dealing with securities. Now, whenever we are talking about stock exchanges in India play a very important role in country's economic development. These stock exchanges in India are regulated by something called as SEBI, which is called as Securities and Exchange Board of India. Now, whenever we are talking about stock exchanges, whenever we are talking about stock exchanges, at present, India has 3 stock exchanges which deal with all financial securities, including the equities, right? Whenever we are talking about Indian stock exchanges market, right, till 2013, there were quite a few stock exchanges working in the country, but slowly they have been allowed to close down one by one. At present, we have 3 major stock exchanges working in India. One is Bombay Stock Exchange, the other one is National Stock Exchange, and the third one is Over the Counter Exchange of India, BSE, NSE, OTCEI. These are the 3 stock exchanges. Bombay Stock Exchange, National Stock Exchange, Over the Counter Stock Exchange are the 3 exchanges that are working in India. Now, coming to Bombay Stock Exchange, girls, it is one of the oldest stock exchanges of the world. Bombay Stock Exchange was established in the year 1875, right? It actually started as a non-profit making voluntary organization in Mumbai, right? It is India's largest and Asia's oldest stock exchange, right? Whenever we are talking about these stock exchange, right, it is India's leading and Asia's one of the oldest stock exchanges. In the year 1957, on August 31st, right, whenever we are talking about stock exchanges. The government of India recognized it under the Securities Contract Act. That is, Bombay Stock Exchange has been recognized under the Securities Contract Act on 31st August of 1957, right? Whereas 1922, the BSE has to be shifted to the Dalal Street. So the stock exchange from which it is currently operating is called as a Dalal Street. Now, what is the history of the stock exchanges? See, BSE has a very important role in Indian economic history, right? Whenever we are talking about BSE, BSE has robed in Indian growing middle class and turned their savings into investment, right? BSE has introduced something called as BSE online trading system to encourage or to show transparency or to remove all kind of errors in stock exchange trading, right? SEBI has allowed BSE to expand its trading terminals to various centers which are outside, right? BSE, whenever we are talking about the BSE, BSE enables its investors to invest in securities which include equities, currencies, debt instruments, derivatives, and mutual funds, right? BSE also provides other important capital trading services like risk management, clearing, settling, right? Investor education. Everything is very, very important aspect of BSE. Now, not only that, BSE also helps in investor education, which facilitates the growth of Indian capital markets across several years. Now, whenever we are talking about BSE, Sensex is the benchmark index of BSE, and it is the most famous one, right? Whenever we are talking about BSE, what is the benchmark index of BSE is Sensex, right? Ever since India went through economic reforms in the year 1991, the Sensex has seen a rapid growth, right? There was a major crash in 1992 due to the financial scam, and but the Sensex has always been recovered through the scams. It has reached to the points of 20,000 in 2007 and crossed the mark of 50,000 in the year 2021 and crossed the mark of 70,000 in the year 2024, right? That is the history of BSE. Now, whenever you are talking about the next important stock exchange, National Stock Exchange, which is called as NSE, is one of the important stock exchange in India, right? It started in the year 1994. It is largest stock exchange in India in terms of total or in terms of average daily turnover for equity shares, right? Now, whenever we are talking about NSE, National Stock Exchange is fully integrated business model which has high quality data and services to market clients or market participants, right? Whenever we are talking about National Stock Exchange, it includes trading services, exchange listing, indices, market data feeds, clearing and investment services. National Stock Exchange of India is the first stock exchange in India which provides modernized or fully automated services through electronic trading. Now, whenever we are talking about the National Stock Exchange, it is a private wide area network in India, right? It is something, right, which deals with what do you call as first, it is a first electronic order book to trade derivatives and ETFs, electronically traded funds. Now, Nifty 50, it consists of the major indexes that you see is Nifty 50. It consists of 50 stocks representing 23 industry sectors which are traded on the National Stock Exchange, right? Now, whenever we are talking about NSE Indices Limited or NSE Indices, right, owns and manages Nifty 50 and the portfolio of 67 indices that are available on the Nifty. Next comes, see, whenever we are talking about NSE makes sure that they make sure that a group of Indian financial institutions, it comprises of a group of Indian financial institutions, right, which will try to bring up transparency, which will try to eradicate errors in Indian stock exchange trading or Indian capital markets. So they follow the rules, They follow the regulations of the stock exchange and provide the services. The next one is over the counter exchange of India. Whenever we are talking about the over the counter exchange of India, it is a stock exchange, but it does not have a proper trading floor, right? It is a stock exchange which is connected via a computer network or transactions, right? And are carried out only via computer operations, right? This over the counter exchange of India was incorporated in the year 1990 under Section 25 of Companies Act 1956. Now, what the main purpose was to provide an alternative market for financial securities, right? For that reason, this exchange was established. The exchange is jointly promoted by UTI, ICICI. It is promoted by IDIB, SBI Capital Market Funds, IFCI, GIC, and Canback Financial Services Limited. These are the organizations, these are the institutions which promote the over-the-counter exchange of India, right? Now, whenever we are talking about OTECI, this model of OTCEI was based on US NASDAQ market. That is, it has introduced many innovative concepts like scriptless trading, no physical trading, only all the trading happens only online, all the trading happens only through international markets. National-wide screen-based trading happens, markets are made, sponsorship of companies is done, right? The exchange was set up only to help the talented entrepreneurs to raise money for new business ideas in a proper manner or in a transparent manner. So OTI is not a market which has a proper trading floor, but everything. See, whenever we are talking about NSE and BSE, we have a proper trading floors in NSE and BSE, but we don't have a proper trading floor in BSE. Yes, Sriman Narayana, do you have any query?
Yes, madam. Sorry to interrupt you, madam. Yeah, can I ask a question, small question, madam? Hello? Yeah, hello, madam.
Yes, sir, you can.
Yeah, why the name Nifty 50?
Yes.
What is the meaning of that Nifty 50, madam?
It actually consists of 50 stocks. So these 50 stocks
means whole Nifty index is.
Sorry?
Index is calculated based on only those 50 stocks.
Yes, but it represents 23 sectors, but the stocks which are representing are only 50, and the what do you call as exchange name is Nifty. That's the reason it is called as Nifty 50.
Oh, are those 50 stocks are constantly will be there in the Nifty 50, or is there any changes over a period of time? Are they going to change those 50 stocks, or same kind of permanently they
No,
are there
it
in the
depends
Nifty 50?
it depends upon the floating stocks. It depends upon the liquidity. It depends on the turnover of these transactions. There can be a change as these indexes periodically also.
Achha, okay. Thank you,
But
madam.
only 50 stocks are traded.
Okay. Index will be calculated based on those 50 stocks.
Yes, sir.
Okay, thank you.
Okay. Shall I continue?
Yes, please.
Yes. So whenever we are talking about this over-the-counter exchange of India model, yes, it is completely based on USA's NASDAQ market. So they will carry out the operations only to help out those entrepreneurs to raise the capital, but they don't have a proper trading floor, which happens only over an internet or which happens only over a computer is what that talks about. Now, whenever we are talking about the participants and players in capital markets, capital market is a market which supplies funds to industries, right, which come from the individuals or which come from the institutions, right, across various sectors. So there are a lot of participants in capital markets. Some of the capital market participants are fundraisers, right? Fundraisers, who are these fundraisers are? Fundraisers are public limited companies which can raise funds either from domestic sources or through international sources. Fundraisers are the people who raise money from domestic sources or international sources. There are somebody called as fund providers. See, whenever we are talking about fundraisers, companies which need money or companies which want to raise money, those kind of players or those kind of participants are called as fundraisers. Fund providers are the people who provide these funds. Like, it can be individuals, it can be institutions which provide funds, right? These kind of people are called as fund providers. See, you again, fund providers can also be domestic or foreign investors. They can be retail or institutional investors, right? They can be buyers from primary markets, or they can be investors of stock market. Anybody who provides the funds of savings, or anybody who provides the funds which are in excess to the fundraisers, they are called as the fund providers. Apart from that, the biggest players in capital market is the intermediaries. They are the service providers who act as a connecting link between fundraisers and fund providers. That is, they are the service providers of the market. They include sub brokers, underwriters, transfer agents, portfolio managers, right? Mutual fund experts who act as a connecting link between fundraisers and fund providers. We have something called as organizational participants like BSE, NSE, MCX. Other regional markets are also there in organizational participants, right? And we have somebody called as market regulators. Market regulators are the regulatory bodies like Reserve Bank of India, Securities and Exchange Board of India, Department of Company Affairs. All these are the market regulators who make sure that the market is operating under a strict rules, or the market is operating in a transparent manner. In order to ensure all these things are done properly, market regulators work. So whenever all these players or all these participants are very, very important in capital markets, there should be fundraisers, there should be fund providers. Only then money can be, or capital can be accumulated, or capital can be formed and used. You need a help of intermediary parties or service providers who act as a connecting link. You need to have an organizational participants, that is people providing physical marketplace or electronic marketplace in order to collect the money. Not only that, you need to have market regulators, which is very, very important. Now, next question that comes into picture is, what are the financial instruments that are traded in capital market, or what are the instruments that are available in capital markets? See, whenever we are talking about the financial instruments in capital markets are the instruments which are used to raise funds, or which are used to collect funds from the market. As we have already learned, capital market is a marketplace which collects long-term funds, or which collect funds which are long-term in nature, right? Those long-term funds put together, right, will become the instruments in capital markets. So it can include governmental securities, they can include semi-governmental securities, they can include corporate securities, depending upon their requirement. So whenever we are talking about the instruments in capital markets, these instruments can be broadly classified into three types: debt instruments, equities, and derivatives. So whenever we are talking about the first one, debt instruments, they are used by governments, they are used by companies to raise money or to raise funds for their projects which are capital intensive, that is, which require more capital or which require intensive use of capital. For those kind of projects, debt instruments are used. Now, these are the instruments which can be either collected from a primary market, or these are the instruments which can either be collected from the secondary market. But they have a specific duration. They have a what do you call as a repayment period. The interest is paid at specified time intervals, right? They can either be paid quarterly, they can either be paid semi-annually, they can either be paid annually, depending upon what is mentioned in the debt agreement, right? So whenever we are talking about debt instruments, usually when companies go for a lot of capital requirement, or when companies want money, excessive money for their projects, they use the debt instruments. Now, whenever you talk about the tenure of this instruments, they vary from a minimum of 3 years to as long as 25 years, depending upon the requirement. Now, whenever we are talking about the debt instruments, when debt instruments have something called as a liquidity period, right? In case of liquidation of the company, if the company's liquidation happens much before the liquidity period, the investors in debt instruments get the top priority in terms of getting their principal amount back, right? Or in terms of getting their money back, debt instrument holders are given the top priority. Bonds and debentures are the most popular debt instruments when it comes to debt instruments. Next comes equity, right? Equities or equity share capital in India, which is also called as common stock. You can call it equities, you can call it equity share capital, or you can call it common stock. All these are the instruments, right? Now, they are the instruments which are issued in the primary market. First time they are issued in the primary market. Once they are issued in the primary market, they are traded in the secondary market, right? They are listed, they are issued by the companies. After the purchase of shares of the company, the investor is purchasing the part of the ownership of the business. So once they are traded, once they are issued in the primary market, then only they can be traded in the securities market, or then only they can be traded in the stock markets. Now, dividends are paid to equity shareholders, right? Whenever they are declared by the company, right? They have high risk. At the same time, they also give you high return when you are talking about the equities market. Next, we have something called as derivatives. Now, derivatives are the financial instruments, right, which derive their value or which determine their value from the underlying assets, right? Hence, because they derive or because they derive their value from the underlying assets, they are called as derivative, right? The underlying the underlying asset can be anything. It can be a share, it can be a gold, it can be a debt instrument, or it can be a commodity like a wheat also. So derivatives is also one of the instrument that can be traded in the capital market. Now, next comes, who will regulate the capital markets? See, capital markets are regulated by various acts. Like it is regulated by Securities Contract Act before the formation of Securities Exchange Board of India. Securities Act 1956 regulated the trading and management of stock exchanges. After the Securities and Exchange Board of India was formed, right, it is the body, or it is the board which regulates the trading and management of stock exchanges in India. That is development, creating investment awareness, what do you call as development of securities market. Everything is taken care by Securities and Exchange Board of India. In 1996, Depositories Act was enacted, right? It regulates the establishment of depositories, right? That is electronic maintenance and transfer of ownership in a what do you call as online format or a dematerialized format. That for enacting that or for controlling that, you have something called as Depositories Act. Next, you have Companies Act. There's something called as Companies Act 1956, which has been amended. Now we have something called as Companies Act 2013, which talks about allotment, transfer of shares, underwriting, payment of interest, dividends, etc. Everything is regulated by the Companies Act when it has to deal with companies. Now, what are the challenges that are faced, or what are the challenges in capital markets? See, capital markets are the markets which deal with long-term debentures or long-term securities. So, changes are brought structurally in capital markets. That is, they include consolidation, they include the already existing business models. There is a gradual change that is happening when it comes to capital markets. Capital markets are not changed just like that. They are changed gradually. And one of the biggest challenge in capital markets is non-traditional players are unable to cope up with the existing state of affairs. They are becoming a challenging aspect to the already existing state of affairs. Like one of the biggest challenge in capital markets is big data, artificial intelligence, and machine learning. These innovations are challenging the capital markets, right? The participants want cost reduction and creation of competitive advantage. This is turning out as the biggest challenge in capital market. Not only that, crowdfunding, peer-to-peer investment trust in real estates and infrastructure are gaining importance, which is becoming a biggest challenge to capital markets. Not only that, straight through processing and use of distributed ledger and blockchain technology is something which has to be needed, right? If you want to overcome these challenges in capital markets. So this is all about capital markets. Next comes money market. See, we have learned that when capital market deals with long-term securities, money market is something which deals with short-term securities or short-term financial instruments. It is a market where financial instruments of short-term nature are traded, and they are traded, the securities which are traded are highly liquid when it comes to money market. See, whenever we are talking about money market is the pillar of financial system, right? Because the time period can range from 1 day, that is overnight, to anything less than 1 year. So whenever we are talking about money market takes into consideration trading, which is of very short term securities, right? Whenever we are talking about money market is a financial market where buying and selling of securities of short-term nature, that is less than 1 year, can happen, right? This money market instruments include treasure bills, commercial papers, etc. So whenever we are talking about money market deals with something called as trade bills. Money markets deal with something called as promissory notes or government papers, right? They meet the short-term requirements or the very short-term requirements of the borrowers and the liquidators. Now, whenever we are talking about money markets are the markets which are defined by Reserve Bank of India as the center for dealing with mainly short-term assets, right? They meet the short-term requirements of the borrowers, and they are highly liquidative. That is, they provide liquidity or cash to lenders very quickly. Now, whenever we are talking about money markets deal with, very short term securities, which can vary from overnight to 1 year, right? And these money markets are comprising of two sectors, that is organized sector and unorganized sector. Now, whenever we are talking about, these money markets are the places which provide you loans, or which provides you investments, or which provide you securities, right? Which are of short-term nature. So whenever you're talking about the organized market comprises of Reserve Bank of India, State Bank of India, other commercial banks, cooperative banks, LICs, GICs, right? All the activities of all these institutions are coordinated or governed by Government of India and Reserve Bank of India. We have something called as an unorganized market, right? We can, if you want money, you can go to bank, or if you want money, you can go to other non-banking financial institutions also, like chit funds, indigenous bankers, nidhis. They are not systematic. They are not, they are regulated or coordinated by Reserve Bank of India, but they don't operate it in a systematic manner. So if you are talking about operating it in a systematic manner, you go to an organized sector. If you're talking about operating it in an unorganized sector, you go to a in not in a systematic manner, you go to an unorganized sector. Now, what are the features of this money market are? Money market only deals with financial assets which have a maturity period of less than 1 year. It can be as short as overnight. The second important features is it gives you, see, capital markets also give you liquidity, but money markets give you instant liquidity. You can immediately convert your assets into cash very quickly in money market. Now, money market is a wholesale market. The volume of transactions that takes place in a money market are usually large and many when you compare it with the capital market. Not only that, money market comprises of several sub markets like call money market, trade bills, right? They have a several sub classifications. Not only that, money market does not have a particular place where borrowers and lenders can meet. No, they don't. There is no specific geographical place. There is no specific geographical position where the borrowers and or lenders can meet each other. In money market, transactions are carried out either through an oral or a telephonic communication. Everything happens through a written document or written communication. Now, the important participants or the important players of money market are central banks, that is Reserve Bank of India, commercial banks, all the nationalized banks or all the public and private sector banks, non-banking financial institutions, regional rural banks, discount houses, everything are, all these are the participants of money market. Now, whenever we are talking about money markets are need-based market where demand and supply happen in that market, and this market also comprises of both organized sector and also unorganized sector, right? Now, what are the functions of money market? Money market is a market which facilitates or which provides economic activity by providing short-term funds to companies or industries and other sectors. They provide a mechanism to achieve the position of equilibrium between demand and short-term of funds. If there is a demand, there should be a supply of short-term funds to equate that or to create an equilibrium. Money markets work. Money markets facilitate effective implementation of RBI's monetary policy, right? Whether monetary policy is properly implemented or not, that can be done only through money markets. Money markets provide a good number of opportunities for short-term investors, right? It helps in capital formations through savings and investment. Money markets are short-term augmentation of funds, right? Which is possible through interbanking transactions. Not only that, money markets help in employment generation, right? They provide funds to governments in order to meet the deficits in their budgets. They are a stable source of funds to banks. They encourage the development of non-banking intermediation. They act as a link between short-term investors and short-term lenders. Now, who are the participants of money markets? Is money market has a lot of participants. Like I told you, if you're talking about organized sector, we have government, Reserve Bank of India. If you are talking about organized sectors, you have corporate financial institutions, insurance companies, etc. If you're talking about unorganized sectors, you have something called as a chit fund companies, right? Nidhi running companies. They are the participants of unorganized sectors. Now, the instruments which are traded in money market are, you have something called as treasury bills. These are short-term government securities which are sold with the duration of only 91 days, right? They are traded both in primary and secondary markets. They have a maturity period of 3 months, 6 months, or 1 year respectively. They don't carry any fixed rate of interest, right? And they are sold by Reserve Bank of India through competitive bidding. So treasury bills is one of the financial instruments in money market. Call and short-term notice money at call or money at short notice is one of the instrument where you can call money. That is, money is given within a very short notice. It can take even a day or overnight in order to call the money, right? But it will not exceed more than 14 days. Apart from that, you have something called a certificate of deposit, right? This is one of the instrument of money market. They are marketable receipts, right? They are in the form of funds deposited in a bank. Apart from that, you have something called as commercial bills. These are self-liquidating instruments, that is like bill of exchange, negotiable instruments, right? Which are self-liquidating. Apart from that, you have something called as commercial papers, right? This is also one of the instrument under money market. Or you have something called as repurchase agreement, which is called as repo, right? It that is also, that can be used as a collateral security for short term borrowing or for short term loans. You can use this repurchase agreement. So all these are the instruments traded in money market. Now, what are the challenges that a money market faces? See, money market faces a lot of challenges, like it is it is an absence of integration in two sectors. There's something called as an organized sector, there's something called as an unorganized sector. There is no proper integration, there is no proper coordination between these two sectors, right? It is difficult for Reserve Bank of India to implement monetary policies if there is no integration between these two sectors, right? Because unorganized sector is beyond the control or beyond the purview of Reserve Bank of India. So effective implementation of monetary policies cannot be done if these two sectors are integrated. So that turns out to be the biggest challenge to what you call as money market. Second is multiplicity and disparity in interest rates. There are different and multiple interest rates in two sectors of money market. The rate of interest in rural unorganized sector is high, right? Whereas it varies from the borrower, and the rate of interest is completely different in organized sector. Organized sector follows one rate of interest, unorganized sector follows high rate of interest. So there is a lot of disparity in interest rates. There is shortage of investment instruments in money market. Treasury bills, commercial bills, certificate of deposits, commercial papers are extremely in shortage when it comes to money markets. And the demand in money market is seasonal. It is not constant, it is not continuous, it varies from one season to other season. And insufficient funds or resources, right? Because it is seasonal in nature, the resources supply is short, the savings are not sufficient, or the funds are not sufficient to the demand. And lack of proper bill market. Money market, there's no proper bill market in the money market, though Reserve Bank is making many attempts, right, in order to introduce something called as bill market scheme, but it is not working out, it is not properly structured. Indian money market is still facing that challenge when it comes to proper bill market. And it is high volatile market, right? The call money market is a very short term money market. I told you it can range from one day, overnight, not beyond 14 days. So it is highly volatile. That is, the money is requested at call rate in this money market. It becomes highly unpredictable. The market remains highly unpredictable, and there would be huge changes. So this is one of the important challenge, or this is one of the greatest challenge to money market. So money market, though there is a supply of short term resources, but the proper markets are not integrated. There is a lot of variation, because simultaneously organized and unorganized markets are existing in money market. It becomes great difficult for the Reserve Bank of India to control the unorganized sector. So you see a lot of disparities in terms of interest rates, in terms of effective implementation of monetary policy, uh, in what do you call as sanctioning of money, because it is unorganized structure. Unorganized sector is predominantly available in rural or not too so updeveloped countries. It creates a lot of disparities, or creates a lot of challenges in money market. So these all turn out to be the challenges in money market, right? In the next class, we will learn about the foreign exchange markets. Okay, that's all for today. Thank you.